In the intricate web of the United States financial landscape, a concerning trend is emerging. An increasing number of publicly listed companies, now estimated at a startling 10%, are accumulating debts they are unlikely to repay. These companies, often referred to as zombie firms, represent a growing economic challenge, not just in the US, but globally. The concept of a zombie firm is straightforward yet alarming. These are businesses that, due to various factors including governmental bailouts and bank leniency, continue to operate despite their unviability. The consequences of keeping these companies afloat are far-reaching, often impacting healthier competitors within the same industry. The Federal Reserve's recent aggressive interest rate hikes have started to reveal the true extent of this issue. With the cost of business operations soaring, the thin veil covering these zombie firms is beginning to lift, exposing their financial fragility. The tightening of monetary policy, aimed at curbing inflation, is inadvertently pressuring the economy, forcing a re-evaluation of these struggling entities. The concern is whether this situation represents a temporary blip or a new, enduring reality. If it's the latter, the problems posed by zombie firms, along with underperforming banks and overall economic slowdown, could escalate into a significant obstacle for the U.S. economy. As we delve deeper into this topic, one key question emerges. Is the U.S. financial system inadvertently sustaining these zombie firms, and if so, what will be left in the post-pandemic landscape? Join us as we explore this critical issue and its implications for the future of the American economy. In the ever-evolving economic landscape of the United States, a hidden danger lurks in the form of zombie firms, businesses struggling to survive yet continuing to operate, primarily sustained by the availability of inexpensive credit. While there is no universally agreed-upon definition, certain traits are commonly observed in these entities. These characteristics include being established, rather than new, businesses, overly indebted, and consistently demonstrating negative sales growth. Recent data from the Federal Reserve, gathered before the onset of the pandemic, indicates that around 10% of publicly listed U.S. companies fall into this category. This figure has nearly doubled compared to 2 decades ago, signaling a worrying trend. However, other sources like Credit Risk Monitor suggest even more alarming numbers, estimating that up to 40% of publicly listed U.S. companies might be unviable. Zombie firms can emerge in any industry where debt plays a significant role, such as real estate and energy. These sectors are often less competitive, more financially fragile, and more susceptible to fluctuations in demand. A notable observation is that a considerable portion of these unprofitable U.S. companies are actually growth-focused businesses. Unlike typical zombies, these companies often operate with less leverage and do not carry substantial debt on their balance sheets. When comparing financial metrics, zombie firms generally are smaller, exhibit lower returns on assets, hold lesser cash reserves, and face fewer investment opportunities than their non-zombie counterparts. This precarious financial situation places zombie firms at a heightened risk of collapse, especially if they are unable to secure new credit lines to bridge their financial gaps. The year 2023 has witnessed an alarming increase in corporate bankruptcies, with 516 corporations filing for bankruptcy by September. This surge is a stark contrast to previous years and highlights a significant shift in the corporate landscape. The rise in bankruptcies can be attributed to the escalating costs of doing business, particularly for companies that were accustomed to borrowing at negligible rates. Now, facing interest rates as high as 9% to 10%, many businesses find themselves struggling to remain profitable. An illustrative case is the trucking giant Yellow, which declared bankruptcy in August, resulting in the layoff of some 30,000 workers. Yellow's downfall was years in the making. The company continually borrowed money and sought funding through private equity in hopes of finding new growth opportunities. Unfortunately, these strategies failed to yield the desired results. In its final years, Yellow managed to stay afloat thanks to a substantial $700 million government bailout loan. However, the company only repaid a minuscule portion of this loan before shutting down. This bankruptcy wave has brought to light the unintended consequences of government intervention during the pandemic. While it was crucial for governments to provide support, the aid was often indiscriminately distributed, potentially prolonging the existence of pre-pandemic zombie firms. Now, as the era of cheap money concludes and businesses must borrow at market rates, many are struggling to adapt to the new economic reality. Their business models are no longer viable, and they are burdened with the debt accumulated during times of lower interest rates. This situation is elevating the standards of what companies must achieve to survive. It's becoming increasingly evident that reaching profitability takes much longer than anticipated. Industry experts like Sheila Bair, former head of the FDIC, argue that these bankruptcies are necessary for the economy's health. Weak banks often prolong the existence of failing firms by extending new loans, which allows these banks to delay recognizing losses on existing loans. This cycle perpetuates the existence of companies that, in reality, should no longer be operational. As economists scrutinize the lost decade of the 1990s in Japan, parallels emerge, warning of a similar trajectory for the United States. Japan's economic stagnation during this period serves as an early example, illuminating the long-term consequences of sustaining zombie firms. A critical factor in Japan's lost decade was the combination of undercapitalized banks and ineffective regulatory oversight. These banks, driven by the expectation of government bailouts, had strong incentives to keep zombie firms operational. Consequently, the proportion of zombie firms in Japan increased significantly after 1994, leading to a prolonged period of sluggish economic growth. Turning the lens to the current U.S. banking system, concerns arise regarding the potential replication of Japan's scenario. Presently, U.S. banks are grappling with substantial losses in their portfolios, coupled with an expectation of maintaining profitable interest rate spreads. The crux of the issue transcends the immediacy of earnings seasons and delves into the bank's real capital strength. The critical question is whether U.S. banks possess sufficient capital to support the economy over the next decade. If the bank's capital reserves are not as robust as previously assumed, the risk of the U.S. economy experiencing its own lost decade looms large. This scenario would not only mirror Japan's past struggles but also highlight the broader economic risks associated with sustaining zombie firms. Economists are scrutinizing key U.S. industries like airlines and automobiles for their reliance on high debt levels and potential expectations of government bailouts. Current dynamics indicate that even if the economy falters significantly, the government's capacity to intervene, as in the past, is now limited. The ongoing fiscal debate underscores the unsustainable trajectory of national debt and the urgency to shift paths. Despite the burgeoning national debt, some market analysts perceive the U.S. economy as exceptionally resilient. Contrasting views argue that the parallel with Japan's lost decade is not entirely applicable. Factors like the incremental growth of the supply side, labor market expansions, and measures implemented post-2008 to fortify financial stability are seen as differentiators from Japan's experience. However, the Federal Reserve's rising interest rates pose new challenges. These rate hikes are expected to weed out weaker market players, emphasizing the newfound attractiveness of cash as an asset class and imposing constraints on riskier assets. The full impact of these heightened rates is only beginning to surface, potentially reshaping the business landscape, banking sector, and the broader U.S. economy. At the crux of this situation is the human element. Investors and banks may be reluctant to acknowledge past misjudgments in lending, reflecting a natural aversion to admitting losses. This hesitancy to recognize failed investments could contribute to sustaining unviable businesses longer than necessary, leading to further complexities in an already intricate economic scenario. Share your views in the comments, and if you found this video enlightening, don't forget to leave a like and subscribe to the channel for more in-depth analyses and intriguing stories from the finance world.